Hi, my name's Ben McGarry. I'm the portfolio manager and founder of Totus Capital, an independent fund manager based in Sydney. I founded Totus back in April 2012 with the objective of protecting capital and growing it regardless of what was going on in the broader economy. We currently manage money on behalf of high net worth individuals, family offices and fund of funds, and we've recently opened our flagship Alpha Strategy to non-wholesale investors via a retail PDS. We're big believers in limiting capacity to maintain performance, and we're closing the Alpha Fund strategy to new investors once we reach 500 million Aussie dollars of assets under management. We're fundamental stock pickers, and we're trying to deliver performance from both our long and our short book, which gives us the ability to perform in up and down markets if we do it right. I'm a large investor in the fund, and our investment team all have a significant portion of their net wealth invested in the Alpha Fund. The strategy has delivered excellent returns of 18.6% net of all fees per annum since inception. The ASX 300, including dividends, has delivered just over 6% over the same period. Importantly, our returns are uncorrelated to Australian and global equities. Looking at our performance over the last 8 years, you'll see a number of periods where the fund has gone up during periods of market volatility or turbulence. The first was during the European debt crisis back in 2012, where the fund was up 8% in its first 3 months with the market down 5%. 2015, which was a difficult year for equities, was the second best year for our fund since inception, when markets trended down from April 2015 through to February 2016. And of course, most recently, the first quarter of 2020 was a difficult one for equity markets, but a strong one for our fund. As you can see from this slide, the performance of the fund has been relatively consistent over the 8 years, with only one down year in 2016. And importantly, it's been delivered over a range of assets under management, including the most recent year, has been very strong despite growth in assets under management. For those of you interested in performance quality, this slide looks at how the fund has delivered those returns. We've delivered alpha, or performance, in excess of the market of 12.2% per year for the first 8 years. And importantly, our beta and correlation to the market has been close to zero and is currently negative. Looking at what our edge is, or our key point of difference, it's that performance in down markets for the ASX. The Totus Fund has, on average, consistently outperformed during down markets. We've also delivered solid returns in months when the ASX is up. Our short book has been a consistent source of alpha generation, or absolute returns. When you combine that solid performance in up months with consistent performance in down months, the result has been superior, uncorrelated, risk-adjusted returns for 8 years. This slide looks at how the fund has performed in the 15 worst months for the ASX since we launched, and we've delivered a positive return in 10 out of those 15 months. We've also delivered a positive return in 11 out of the 15 best months for the ASX since April 2012. This slide shows our net and gross exposure since inception. We can be net long the market or net short the market. We've averaged a net exposure to the market of just under 40% over the first 8 years of the fund, and we're currently net short equities. Why are we net short? Well, we think we're in a bear market. We've seen one of the biggest economic events we're likely to see in our lifetimes, and we don't think it's going to be over in a matter of weeks. The strong bounce back we've seen in markets in recent weeks is normal in a bear market, and we think that after a long period of high asset prices and low volatility, that we're likely in for an extended period of asset price volatility. How have we delivered those returns? It's simple. We try to look for parts of the market where there are headwinds and tailwinds. We're looking for themes or economic events that can provide a positive or a negative environment for a company or an industry to earn profits. We like companies that generate lots of cash, that have strong balance sheets, that aren't heavily reliant on external debt or equity markets to fund their growth. We like companies that present their accounts conservatively with minimal use of accounting trickery or aggressive accounting to dress up earnings. We like management teams that do what they say they're going to do and business models that are simple enough for us to understand. On the short side, we're looking for the opposite of those things with a catalyst for the market to focus in on them. This slide looks at some of the stocks that we've been short over the first 8 years of the fund's life that have gone down over 50%. As you'll see, there's been a consistent opportunity in the mid-cap part of the Australian market in the under-researched or poorly researched company space, often in some of the companies that are the most aggressively pushed by the sell side of the industry. Investment banks work by earning fees and raising money for companies. Those companies that are heavily reliant on external capital to fund their growth or operations are often not the best companies to be invested in for long investors. And taking on those promotional companies that are constantly raising money has been a consistent source of absolute performance for our fund, albeit they can be lumpy. Up until 2020, our biggest short winner was actually a large cap US stock. We have focused increasingly on US large cap shorts in recent months as a nice balance to many of our longs, which are also tilted towards large cap US stocks, in particular in the tech space, ones with extremely good market structures, strong balance sheets, and high cash generation. We think they're the kind of businesses that are likely to survive and thrive in a post-pandemic market environment. Looking at some of our portfolio highlights, you'll see those large and mega cap businesses feature heavily in our top 10 long positions. But we also have a smattering of high quality Australian mid-cap companies with conservative accounting, strong cash generation, and defensive earnings qualities. Objective Corp and Smart Group are two of those names. We think that this current bear market, or recession, depression, call it what you like, is an opportunity for the strong to get stronger. The likes of Amazon and Microsoft should benefit from the move to more of our economic activity being conducted in the cloud. The virus has accelerated the move away from cash, which should benefit the likes of Visa and MasterCard. The CME Group, one of our larger holdings, is a big beneficiary of increased volatility that comes about during times of market disruption and dislocation like what we're experiencing. Some of these companies will take short-term hits, but what we're saying is that this market environment should provide good opportunities for them to gain share over the medium to longer term. On the short side, we have a range of themes that are delivering performance in our book. There's the old fads, frauds and failures, which have been a consistent source of lumpy performance for our book. But we've also got a lot of businesses that are going to struggle in a low or zero interest rate environment. Traditionally, that's been a very difficult environment for financial services companies. For example, there's a lot of companies that have large fixed cost bases that are impacted by the pandemic, and we think it's very unlikely that we're going to see a V-shaped recovery in industries like tourism, leisure, or education, for example. As mentioned earlier, the Alpha strategy is now available to non-wholesale investors via a retail PDS. We're closing this strategy to new investors at 500 million of assets under management. We're currently at 250 million, so if you're interested in accessing this product, please get in touch with us on the details on your screen now, or fill out the contact form at the bottom of this wire. Thank you for listening.